Hello everyone, I'm Sidhant. Today we are taking the chapter number 11, that is the challenges facing Indian economy. Before entering into the MCQs, we will take some concepts, that is the basic of this topic, and then we will move into the MCQs. What are the challenges facing Indian economy? There are lots of challenges that is facing Indian economy, but the book is talking about some few points that I will discuss it with you, and we will stick to that only, and we will not deviate. So in this topic it is saying that India is facing the twin deficit, that is the fiscal deficit and the current account deficit. So before understanding, as we in the last chapter we discussed the fiscal deficit, now in this chapter we will discuss some topics, some terms, so that you can understand the MCQs as well as the things. So there are four terms that is required to understand. First is current account deficit, another one is trade deficit, another one is service surplus, and fourth one is balance of payment. Okay, so we will first see the trade deficit. So if India is exporting and importing, but the import of the goods, only goods, we are not taking the service, import of the goods minus export of the goods, so the difference between them is the trade deficit. India is standing at minus $170 billion. It means that we are importing more than exporting things. But if we talk about service surplus, that we are exporting more than importing services. Services includes the software services, the banking services, etc. India at dollar plus 75 billion. And if we talk about the current account deficit, it's the sum of this two. So current account takes the import and the export of all the goods and the services. So that is current account deficit. It's in negative trend in India. And balance of payment, if we take current account deficit plus whatever the investment comes to India, then India invests outside. So this current account deficit plus the difference between the investment inside India, then India invests outside. That difference plus the remittances comes inside India minus the remittances goes outside India. So in this, if we add all this thing, we will get the balance of payment, which is in positive trend. India is at positive as far as the balance of payment is concerned. Now we will see the questions. First, unique feature of the Indian economy. What is the unique feature of the Indian economy? We will see the options. Growth driven by the domestic demand. Yes, our population is so much that whatever we produce, we consume inside India only. Most of the products get consumed inside India. So this is an edge to our economy, that growth driven by the domestic demand. Option B, situation of the twin deficit, that is fiscal deficit and current account deficit. Fiscal deficit, we have learned in the last chapter that it's a difference between the expenditure and the revenue earned by the government. So this is also true. The situation of the twin deficit, that is fiscal deficit and current account deficit. Option C, India is a supply constrained economy. Yes, why supply constraint? Because the population is so much, even if some bad quality of goods produced, it got consumed by the people. So India is a supply constrained economy because of its population. There is lots of demand of whatever the goods the manufacturer produce. So here the option D is all correct. Next question, India falls under which category of the economy? There are generally four categories of the economy. One is developed, another emerging market economies, third is developing, and fourth is the least developing. So India comes under developing, and some of the newspapers or somewhere you must have read that India is an emerging market economies. Yes, it can be, but it will be more appropriate to tell that India is a developing economy. Emerging market economies are those economies which are in positive trend as far as the current account deficit, or they are export oriented countries generally. So it is more appropriate to tell India is a developing economy. Next question, in emerging market, central banks have the following options in the managing capital flows. First we will see what do you mean by emerging market, as it's a emerging market, as we have seen that emerging, which is emerging in all the trends, which is growing in all the parameters, like GDP is increasing, export is increasing, and all. So central banks means RBI have the following. I'm giving an example of the central banks of any country. Central banks have the following options in managing capital flows. What are capital flows? Anything that is related to the assets is the capital flows. For example, currencies, foreign exchange currencies are example of the capital flows. So option A, not to intervene in the forex market. Yes, previously what RBI does, RBI decides the exchange rate, but now it all depends on the market. So RBI is not intervening in the forex market. Option B, intervene but to refrain from sterilization. Sterilization, we have discussed in the last last to last chapter, that there is something called MSS, market stabilization scheme. So whenever the government exercise the market, RBI exercise MSS, that is market stabilization scheme, that process is sterilization. So what they actually does, for example, the Facebook is investing in Geo. So when they invest in Geo, first they exchange currency, they bring dollar, they take Indian rupees, and they invest in the Indian market. So there are lots of Indian currency available in the Indian market, and when there is a lots of currency available, it will create a lot of problem, like it will increase the inflations and all. So in order to make the adjustment, the RBI sucks the extra surplus money from the market. That process is the sterilization or the market stabilization scheme. So option B is also true, that intervening but to refrain from sterilization. They want to intervene a little bit, not completely, but they shy away from doing the sterilization process. This is true. Option C, sterilize the intervention. Sterilize the intervention. The basic meaning of the sterilization means to control. So control the intervention. Yes, they will not intervene much. They control themselves to intervene in any of the things. They first leave it to the market. Then if it is not done, then they will enter. For example, when the Indian currency exchange against the dollar increases to 80, then RBI will intervene and they will try to adjust the exchange rate. Otherwise it will not, if it is increasing or decreasing 0.30 paise or otherwise. Next question, stickiness in the interest structure. Okay, what do you mean by stickiness? Stickiness means, for example, in India you will get a lots of interest against your deposit. For example, if you are doing fixed deposit, you are getting around 6 to 6.5%, and even if you take some other schemes like Sukanya Samriddhi, you are getting 9.5. That is really very high. That is not very efficient for the bankers, for the banking businesses, or for the government. So that's why the Indian interest structure of the banks is called is termed as stickiness. So the question is, stickiness in the interest structure of the banks in India is due to: option A is higher rate of interest offered by the small saving instruments, which discourages banks from reducing deposit rates. Yes, this is true. Option B, high cost of deposits raised by banks during tight monetary policy regime. Monetary policy rates changes, the cost of deposit remains almost same. That's why the option B is also true. Option C, large government borrowing program that pushed the yield on the government securities. As we know that the government is borrowing a lot from the market. So whenever they issue a lot amount of bonds in the market, so there will be less demand as there is more number of bonds available. And whenever there is a less demand, the yield will increase. So when the yield will increase, so the government has to make more interest payment as compared to the last one. So option C is also true, and the answer is D, all of the above. Next question, traditional method to safeguard financial stability do not include. It is asking the safeguard mechanism or the financial stability. Let's see. Exposure norms is acts as a safeguard or not? What do you mean by exposure norms? For example, any banks is allowed to give maximum 5% or 10% of their loan, of the total loan, to a single entity or the company. So that is something as safeguard norms, because you can't give all your money into a single entity like in the. So exposure norms is act as a safeguard. Option B, prescription of the risk weight for the capital adequacy. As you know that capital adequacy ratio, we assign the risk to all the loans. For example, personal loan has a very high risk, just because it is not because the security is not taken from the customer. But if you take home loan, the security is there as a mortgage, the home itself a mortgage, so that is less risky. So this is also a safeguard mechanism, prescription of the risk weight for the capital adequacy. Option C, provisioning requirement on the assets. As we know that we do a provisioning for all the loans that we have, and that will help when the assets becomes a non-performing assets. So this provisioning is also a safeguard mechanism. Next option, KYC guidelines. Yes, KYC guideline is also a kind of safeguard mechanism, but in the question it is asking traditional method. All the three are traditional method, but KYC guideline is not a traditional method. It recently introduced after the prevention of money laundering very frequently, which happens all around the world. Then this KYC guidelines comes into picture. So that's it. This chapter is done. Now we will take one module of the BFM. We are done with the module A. That's a very good point. We have covered a lots of things, and this module A is very important for the scoring point of view. You will score a lot of marks in this section. So that's it. Please subscribe the channel. Thank you.